$5,019.69. That is the exact price of 1 ounce of gold as you're watching this video, according to Kitco's live feed. And that number represents a drop of roughly $100 in a single week. On the surface, that sounds like bad news for gold holders. But here's what nobody in mainstream financial media is telling you right now. While New York's paper market is dumping gold and driving the price lower, the Shanghai Gold Exchange is simultaneously pricing physical gold at a premium of up to 14% above what COMEX says it's worth. 14% on the same metal at the same moment in history. In a normal, functioning, healthy market, that gap should be zero. It should be impossible. And the fact that it isn't zero, the fact that it's sitting right there, fully documented, fully visible for anyone who wants to look, tells you something absolutely critical is breaking underneath the surface of the global gold market. By the time we finish today, you're going to understand exactly what's happening, why it's happening, what it means for where gold goes next, and most importantly, what it means for you personally. Let me give you the full picture of what's going on this week, because the news cycle around gold right now is genuinely confusing. Gold peaked at $5,594.82 on January 29th of this year, an all-time record. Then it started pulling back. Right now, as of March 15th, 2026, we're sitting at approximately $5,019 on the spot market. That's a pullback of about 10% from the all-time high. And the mainstream explanation for why gold is falling goes something like this. The US-Iran war that broke out in late February has sent oil prices surging past $100 a barrel. Higher oil means higher inflation. Higher inflation means the Federal Reserve keeps rates elevated for longer. And the Fed meeting is coming up this Wednesday, March 18th, where 95.6% of market participants expect rates to stay unchanged at 3.50 to 3.75%. Elevated rates strengthen the dollar. A strong dollar makes gold more expensive for foreign buyers, and so gold pulls back. That explanation is technically true as far as it goes, but it's incomplete in a way that's almost dangerous if you're trying to understand what's actually happening. Because while all of that is true in the paper market, the world of futures contracts and derivatives and digital claims to gold, the physical gold market is telling a completely different story. And those two stories cannot both be correct at the same time. I want to be crystal clear about something before we go further, because I know some of what I'm about to show you sounds alarming. This is not speculation. This is not conspiracy theory. Every number I'm going to give you is documented in exchange filings, official reports, and institutional analysis you can verify yourself. The Shanghai Gold Exchange publishes its data publicly. The CME Group publishes COMEX inventory reports. JP Morgan, Goldman Sachs, Deutsche Bank, these institutions have put their price targets in writing. I'm going to cite all of it as we go. Now let me build this out properly, because what's happening right now has happened before. 3 times in modern financial history you've seen this exact pattern. A paper market telling you one price, a physical market screaming a completely different number, and the gap between them eventually snapping closed, violently, and always in the direction of physical reality. The first time was in 1971, Bretton Woods. The US government had been promising foreign central banks that 1 ounce of gold equaled $35. But the physical gold in Fort Knox couldn't back all the paper dollars floating around the world. France started demanding actual gold for their dollars. Other nations followed. The gap between the paper promise and physical reality became impossible to maintain. Nixon closed the gold window on August 15, 1971. Within 2 years, gold had quadrupled. The paper price repriced to physical reality, not the other way around. The second time was the Hunt brothers' silver squeeze of 1979 to 1980. The Hunt family accumulated roughly 200 million ounces of physical silver. The paper futures market kept telling the world silver was cheap. Physical silver was vanishing. The gap widened until it snapped. Silver went from $6 an ounce in 1979 to $50 an ounce in January 1980, an 800% move in roughly 13 months. The paper market eventually repriced to reality. And then the exchanges changed the rules, raised margin requirements, and forced a collapse. Sound familiar? We'll come back to that. The third time was the London Metal Exchange nickel crisis of March 2022. Tsingshan, a Chinese nickel producer, had massive short positions on paper nickel contracts. Physical nickel supply got tight. The paper price and the physical price diverged. Then one morning, nickel on the LME surged from around $25,000 a ton to over $100,000 a ton, a 250% move, in less than 48 hours. The LME suspended trading and canceled billions of dollars in completed trades. The paper market had to be literally shut down to prevent the physical reality from destroying it. Those three events share one common thread. When physical and paper markets diverge long enough and far enough, reality wins. Every single time. Quick note for those of you who aren't subscribed yet. My analytics show roughly 3 out of 4 people watching right now haven't subscribed. If this kind of analysis is cutting through the noise for you, please hit subscribe. That's how I know who the committed community is. It helps the algorithm show this to more people who need to see it, and it keeps me motivated to keep digging into this stuff. Now let me show you the specific evidence of where we are in this pattern today, because the data is extraordinary. Start with COMEX. The commodity exchange, part of the CME group, is where most Western gold and silver futures are traded. A futures contract is a promise to deliver a specific amount of metal at a specific price on a specific date. COMEX is essentially the global headquarters for setting gold and silver prices. But here's the thing. COMEX operates on a fractional reserve system. This is not a conspiracy theory. This is literally how futures markets are designed to work. There are vastly more paper contracts outstanding than there is physical metal in the vaults. Most people who hold these contracts never actually demand physical delivery. They roll them over or take cash settlement. The whole system works beautifully until it doesn't. Until people start actually wanting the metal. Now look at what's happening to COMEX inventories right now. According to data published directly by the CME group, registered gold inventory, that's the gold specifically designated as available for immediate delivery, has been draining at a historic pace. This mirrors what's happening in silver even more dramatically. Registered silver stocks fell to approximately 86.1 million ounces by the end of February 2026. That's a 31% decline from levels seen just months prior, according to documented COMEX filing data. And on first notice day for the March silver contract, delivery notices were issued for 10,526 contracts, representing roughly 52.63 million ounces of silver, more than 60% of total registered inventory in a single month. Think about that for a second. If you have 100 units of something in your warehouse, and customers demand delivery of 60 of them in 1 month, you've got a problem, a serious one. And the buffer between what's available and what's been promised has reached its thinnest margin in exchange history, according to analysis published by Financial Content on March 4th of this year. But it gets worse. Here's what makes this truly alarming, and this is where the Shanghai premium becomes the smoking gun. In a properly functioning global commodity market, gold and silver should trade at roughly the same price everywhere on Earth, plus or minus a small amount for shipping and insurance. If gold is $5,000 in New York and $5,050 in Shanghai, someone immediately buys in New York, ships it to Shanghai, pockets the $50 difference, and keeps doing it until the price equalizes. That's called arbitrage. It's one of the fundamental mechanisms that keeps global commodity markets honest and efficient. So when the Shanghai Gold Exchange is pricing physical gold at a persistent premium of 8 to 13% over what COMEX paper contracts say gold is worth, and that premium isn't closing, there is only one possible explanation. There is not enough physical metal to ship from New York to Shanghai to close the gap. The metal doesn't exist in sufficient quantities to do the trade. The arbitrage that should happen mathematically cannot happen physically. This premium has been documented consistently since late 2025. On December 24th of 2025, physical silver on the Shanghai Gold Exchange closed at $78.49 per ounce, while COMEX futures were around $70. A gap of over $8 on silver. By early 2026, that spread had grown to $10 to $20 on silver, according to analysis published by silver market analysts. And the gold premium has been running at 8 to 13% above New York prices, with no signs of closing, according to reporting from Financial Content. Why can't traders just ship the metal? Because when they try to pull physical gold out of COMEX vaults to ship it east, they're discovering that the metal they thought was there isn't actually there in the quantities the paperwork suggests. The same metal appears to be promised to multiple parties simultaneously. It is the classic hallmark of a fractional reserve system approaching its limits. Now let me give you the bigger macro backdrop, because the Shanghai premium doesn't exist in isolation. It exists inside a seismic shift in global gold demand that has been building for 3 consecutive years and is accelerating right now. According to data from the State Street Monthly Gold Monitor published in February 2026, the US dollar's share of global foreign exchange reserves has fallen to its lowest level since 1994, approximately 40%. At the same time, gold's share of global reserves has risen to its highest level since 1991, approximately 30%. And here's the number that puts that in stark relief. As of year-end 2025, USD reserves were down about 12% year over year, while gold reserves were up approximately 40% year over year. Central banks around the world are not gradually diversifying. They are aggressively, urgently, systematically replacing dollar reserves with gold. The People's Bank of China, the PBOC, has extended its official gold buying streak to 16 consecutive months as of March 2026, according to a financial content analysis published on March 12th. Their reported official holdings now stand at 2,308 tons. But industry analysts suggest China's true gold holdings, when you include state-owned banks and purchases routed through the Shanghai Gold Exchange, could range between 3,000 and 5,000 tons. That's a significant portion of all the gold that's ever been mined in human history sitting in Chinese hands, and the official numbers are almost certainly understating it. Meanwhile, JP Morgan's research team has put in writing that they expect 755 tons of central bank gold purchases in 2026 alone. Goldman Sachs has set a 2026 price target of $5,400. JP Morgan has gone further, suggesting a structural rebasing could push gold to $6,300. Deutsche Bank has a year-end target of $6,000. BNP Paribas just raised their average 2026 gold price forecast by 27% to $5,620, with a peak above $6,250 likely by end of year. These are not fringe analysts. These are the largest financial institutions on Earth, the ones with the most sophisticated research teams, the most access to confidential flow data, telling you privately, through their research notes, that the gold they sell you paper exposure to on one hand, they're stockpiling physically on the other. Here's something else I want you to sit with. The non-farm payroll report, released on March 7th of this year, came in at negative 92,000 jobs. That's not a small miss. That's jobs being destroyed. The labor market is showing cracks. Core PCE inflation, the Fed's preferred inflation gauge, came in at 3.1% year over year in January, which is well above the Fed's 2% target. Producer prices in January showed a 0.8% monthly increase, the strongest in months. So you have an economy that's simultaneously losing jobs and dealing with persistent inflation, stagflation, the worst possible scenario for traditional monetary policy. The Fed can't cut rates without stoking more inflation. It can't raise rates without crushing an already weakening labor market. It's caught. And historically, when the Fed is caught like this, when monetary policy has no good options, gold is the asset that benefits most structurally, even when it wobbles in the short term. Now layer on top of that the US-Iran conflict. Oil above $100 a barrel, the Strait of Hormuz, the maritime corridor through which roughly 20% of the world's oil and gas passes, is effectively closed. The US Treasury has had to announce waivers on some sanctioned Russian crude just to try to stabilize energy supply. Marine insurance premiums are surging. European nations are being drawn into the conflict. This is not a contained regional conflict. This is a geopolitical event with direct implications for global inflation, energy markets, and the durability of dollar-denominated trade. The fact that gold is only down about 10% from its all-time high in this environment, holding above $5,000, is actually remarkable. It suggests the floor underneath gold is extraordinarily strong enough to withstand a surging dollar, surging treasury yields, and a genuine war in the Middle East simultaneously. But let me come back to the disconnect now, because this is the part that should genuinely alarm you if you're paying attention. The paper gold market in New York is currently pricing gold at around $5,000. The physical gold market in Shanghai is simultaneously pricing gold at a persistent premium of 8 to 13% above that number. That gap has been documented, measured, and reported on by multiple independent sources, including the Shanghai Gold Exchange's own published benchmark data, and analysis from financial content, silver trade, and institutional research. When you overlay the silver market data, the picture becomes even starker. COMEX registered silver inventories have dropped 64% from their April 2020 peak of 240 million ounces down to approximately 86 million ounces today. At the same time, Shanghai inventory has dropped 43% from 559 tons in November 2025 to approximately 318.5 tons in February 2026. Both the Western vaults and the Eastern vaults are draining simultaneously, which destroys the backup thesis that you can always arbitrage metal from one market to solve a shortage in the other. Now here's what makes this mathematically alarming. On first notice day for the March COMEX silver contract, more than 52 million ounces of silver were demanded for physical delivery. That's against registered inventory of 86 million ounces. So 60% of the available inventory is claimed in a single delivery month. Open interest on the March contract was running between 85,000 and 91,000 contracts, representing a theoretical delivery obligation of 425 to 455 million ounces. Even if only 20% of those contracts demanded physical delivery, a conservative historical average, COMEX would need to produce 85 to 90 million ounces. That's essentially their entire remaining registered inventory. Gone. In one delivery cycle. The CME Group's response to this has been textbook. They've done what exchanges always do when physical reality threatens paper claims. They've raised margin requirements dramatically, currently sitting at 60% for silver futures, and they've introduced cash-settled contract alternatives. In plain English, they're making it more expensive to hold contracts, and they're offering people cash instead of metal. This is financially equivalent to a bank telling customers, "We're low on cash, but we'd love to send you a check." It manages the immediate crisis, but does not solve the underlying physical shortage. Let me show you the institutional fingerprints in this, because this is where it gets into territory that veterans of these markets recognize very clearly. The CME Group, which owns and operates COMEX, is not a disinterested party here. They profit from trading volume, from margin requirements, from the complexity of the instruments they sell. When they change the rules mid-delivery cycle, they are explicitly prioritizing the integrity of their paper system over the legitimate claims of holders who want physical metal. We've seen this movie before. In 1980, when the Hunt brothers' silver squeeze threatened to break the paper system, the exchanges introduced Silver Rule 7, a rule that restricted silver futures trading to liquidation only. You could sell your contracts, but you could not buy new ones. This forced a one-way market that crushed the price. The rule change was designed to protect the institutions that were short silver, not the people who owned it legitimately. I'm not saying that's happening right now with gold. I'm saying the institutional toolkit for managing delivery stress is well established, well documented, and has a consistent historical track record of prioritizing paper system stability over physical claimants. That's just a fact. It's in the historical record. And the current playbook, margin hikes, cash-settled alternatives, is the same toolkit being deployed right now according to the financial content reporting on the March 2026 COMEX delivery season. Now, who are the main commercial players that are net short precious metals on COMEX? According to commitments of traders data, public data, anyone can pull this, commercial banks including JP Morgan and HSBC have historically held massive net short positions in precious metals. These are documented positions, public filings. Commercial shorts, by definition, are people who've promised to deliver metal they may or may not actually have. When physical scarcity develops, those short positions become enormously expensive to defend, which creates the squeeze dynamic. Speculative positioning in gold is currently sitting around the 31st percentile of the last decade. That means there's enormous room for more speculative longs to pile in. The squeeze pressure hasn't built to its historical peak yet. So let me make this personal now, because what does all of this actually mean for you? If you're holding physical gold, actual bars or coins you can touch, not an ETF, not a futures account, you're holding the thing that 3 separate global financial institutions can't agree on the price of right now. And when that disagreement resolves, history says it resolves upward. The $5,019 price you see on your screen right now is a paper price set by a market that has demonstrably less physical metal to back it than the price implies. That's not a bull thesis built on hope. That's a mechanical observation built on inventory data. If you're holding gold through a paper product, an ETF like GLD or a futures account, you need to understand what you actually own. GLD holds physical gold on behalf of its shareholders, and the Sprott Physical Gold Trust holds fully allocated gold as well. But these are fundamentally different from the peace of mind of holding metal outside the financial system entirely. During a genuine delivery stress event, not a prediction, just something to understand, paper claims get resolved in cash, not necessarily in metal. The Sprott Physical Silver Trust has been trading at a premium to its net asset value, specifically because investors are paying extra to ensure physical backing, according to the financial content reporting. That premium is the market's way of saying, we don't fully trust paper claims right now. If you've been sitting on the sidelines waiting for a better entry point on gold, consider that in every historical precedent, 1971, 1979, every period of physical paper divergence, the entry points that looked expensive in hindsight were the ones right before the paper market repriced to physical reality. The gold price dropped to $5,019 this week, while Shanghai is pricing physical gold 14% higher, is not a warning to sell. According to the analysis from goldsilver.com published yesterday, March 14th, the $5,000 level is the line to watch. As long as gold holds above it, this is a correction inside a bull market. And so far, despite everything, The Iran war, the strong dollar, the inflation fears, the elevated rates, gold is holding above $5,000. That floor is remarkably stubborn. Now let me talk specifically about what to watch in the next 30 to 60 days, because several catalysts are converging that will likely resolve this tension one way or another. First, the Federal Reserve decision on March 18th. Markets are 95.6% convinced rates stay unchanged. If that happens, and the statement signals rates staying high for longer, you could see another short-term pressure on gold as dollar strength persists. Watch for the language around inflation expectations and the timeline for potential cuts. If the Fed signals July as the earliest possibility for cuts, which is currently the market consensus according to CME FedWatch data, gold will likely stay range-bound between $5,000 and $5,200 in the near term. Second, watch the COMEX registered inventory numbers every week. The CME publishes these. You can verify them directly at cmegroup.com. When registered inventory drops below a certain threshold relative to open interest, delivery stress goes from theoretical to acute. Right now, we are watching those numbers in real time. Third, watch the Shanghai premium. If the premium stays elevated or widens beyond 14%, it signals the physical supply shortage is worsening. If it narrows towards zero, it suggests either COMEX has found a way to deliver metal east or Chinese demand has softened. The direction of that premium is your most accurate real-time gauge of physical market stress. Fourth, the U.S.-Iran conflict. If the Strait of Hormuz remains effectively closed, oil stays above $100, inflation expectations stay elevated, the Fed stays on hold, and gold's fundamental case keeps building even as the paper price wrestles with dollar strength. If a ceasefire emerges, and there are quiet diplomatic signals that one may be possible in the coming weeks, oil drops, the dollar softens, the inflation pressure eases slightly, and suddenly the Fed rate cut timeline could move forward again. That scenario, paradoxically, could be very bullish for gold in the medium term because the immediate dollar strength headwind evaporates. Fifth and finally, the Federal Reserve chair situation. Donald Trump nominated Kevin Warsh to replace Jerome Powell. Warsh has been described as someone who would potentially be more willing to maintain tighter policy, which would be initially negative for gold in the paper market. But consider the broader context. Whoever leads the Fed inherits a fiscal situation where the U.S. national debt has now surpassed $36 trillion, and annual interest payments on that debt have exceeded $1 trillion for the first time in history. The structural pressure for eventual monetary easing, regardless of who runs the Fed, has never been greater. There's a question I want to ask you to sit with. When you hear that gold fell from $5,240 to $5,019 this week, a move of roughly $220, and you simultaneously hear that physical gold in Shanghai is trading at a 14% premium over New York prices, and that COMEX registered inventories are at historic lows relative to delivery obligations, and that central banks bought over 1,000 tons of gold in each of the last 3 consecutive years, and that JP Morgan has a $6,300 year-end target, and that BNP Paribas just raised their 2026 forecast by 27%. When you hear all of that simultaneously, what does the falling paper price actually mean? Here's what it means. Short-term paper prices are set at the margin by leveraged traders responding to immediate stimuli. A stronger dollar today, a margin call yesterday, a profit-taking algorithmic trigger this morning. Long-term physical demand is set by central banks, by industrial consumers, by institutional accumulators who think in decades, not days. The leveraged traders create the noise. The physical demand creates the floor. Right now, the floor is at $5,000, and it is holding through a dollar surge, an oil shock, an active shooting war, and elevated rates simultaneously. That is an extraordinarily resilient floor. The history of every previous divergence between paper gold prices and physical gold scarcity ends the same way. The paper market eventually reprices upward to reflect physical reality. Spain in the 1500s watched its purchasing power collapse when paper promises to silver and gold they'd extracted from the Americas ran ahead of actual supply. The Dutch Republic in the 1600s watched tulip paper prices collapse when physical reality couldn't match speculative claims. Britain in the early 20th century watched the pound's gold backing erode until the peg had to be abandoned. Every time, the paper promise eventually met physical reality, and every time people who held physical metal preserved their wealth, while those holding paper claims faced uncertainty. I want to be explicit. I am not a financial advisor. Nothing in this video constitutes financial advice. These are documented market observations based on public data. You should always consult a licensed financial professional before making investment decisions based on your personal situation. Let me bring this full circle. $5,019. That's where gold sits today, March 15th, 2026. Down from a record high of $5,594 in January. Down about $100 this week alone. The mainstream narrative says dollar strength, Iran war, inflation fears, Fed on hold. All true, all real, all short-term. But underneath that narrative, the Shanghai Gold Exchange is pricing physical gold at a 14% premium over the New York paper price, and that premium isn't closing. COMEX registered silver inventories have dropped 64% since 2020 to their lowest levels in exchange history relative to delivery obligations. Central banks around the world collectively bought over 1,000 tons of gold in each of the last 3 consecutive years. The People's Bank of China has been buying gold for 16 consecutive months. The US dollar's share of global reserves has fallen to its lowest level since 1994. JP Morgan sees $6,300 gold by year-end. Goldman Sachs sees $5,400. Deutsche Bank sees $6,000. BNP Paribas, the French banking giant, just raised their forecast by 27% to $5,620, with a peak above $6,250. The paper market is flickering. The physical market is accumulating. These two things cannot both be right forever. The signs are there. They were there in 1971. They were there in 1979. They were there in March 2022, when the LME nickel market imploded in 48 hours. The people who saw those patterns early and acted thoughtfully were the ones who came out on the other side with their wealth intact. The people who said, "But the screen says the price is falling," were the ones caught flat-footed when the paper reality snapped to physical truth. The only question now is whether you're positioned to observe this, or positioned to benefit from understanding it. Drop a comment and tell me this. Are you watching the COMEX registered inventory numbers weekly, or is this the first time you've heard about them? Because I've found that the single most predictive leading indicator of where gold moves next isn't the paper price. It's how much physical metal is actually available for delivery. I read every comment. Your perspective genuinely shapes what I research next, and the discussion in the comments is often where the sharpest analysis in this community actually happens. If this video added something, if connecting the Shanghai premium to the COMEX delivery stress to the central bank accumulation pattern gave you a clearer picture of what's actually happening right now, please subscribe if you haven't. Hit the notification bell. Share this with one person who's asking themselves what gold's pullback to $5,019 actually means. Because the answer isn't, gold is going down. The answer is a lot more interesting than that. And the next video is going to show you exactly where the silver market goes from here. Because if you thought the gold story was alarming, the silver data we're watching right now is in a different category entirely. You'll want to see that one. See you there.